How are we doing, everyone? This is Juan with your weekly watermelon soup for the week ending on Friday, February 20th. All right, so if you're watching this on Friday evening, something just happened a few hours ago that I need to talk about. Anthropic dropped a new product called Claude Code Security, and within hours, cybersecurity stocks got absolutely hammered. CrowdStrike was down 8%. Okta down 10%, SailPoint down 8.5%, Cloudflare, Zscaler, all getting crushed. The cybersecurity ETF, ticker BUG, fell almost 5% and is now down 15% on the year. So what did Anthropic actually release? Claude Code Security is essentially turning Claude into a autonomous vulnerability hunter. You point it at a code base, and it goes hunting for security flaws, including 0 days, which are vulnerabilities that nobody knows about yet. This builds on research that Anthropic published a couple weeks ago when they launched Opus 4.6. Their Frontier Red team, that's their internal security research group, tested the model on open source software. They gave Claude access to standard security tools, Python, debuggers, fuzzers, but no specific instructions. And the result was that Claude found over 500 previously unknown 0-day vulnerabilities in software that runs critical infrastructure. Some of these flaws had been sitting there for decades. Logan Graham, head of Anthropic's Frontier Red team, told Fortune today, "I wouldn't be surprised if this was one of, or the main way, in which open source moving forward is secured." Think about that. He's saying AI might be the primary method of securing code. Here's why cybersecurity stocks immediately sold off. CrowdStrike, Okta, SailPoint, Zscaler, these companies sell security services. A big part of their value proposition is finding and fixing vulnerabilities before attackers do. If Claude can do that autonomously, out of the box, without specialized tooling, what exactly are you paying those security vendors for? This is the SaaSpocalypse playbook we've been tracking all month. Week 1, Claude Cowork launches with legal automation plugins. Legal tech stocks tank. Week 2, the sell-off spreads to broader SaaS. Salesforce, ServiceNow, Workday, they all crater. Week 3, $2 trillion is wiped from software market caps. And today, Claude Code Security launches. Cybersecurity's stocks get hit. It's almost predictable now. Anthropic releases a specialized tool and the adjacent industry loses billions in market cap within hours. Now, Anthropic knows this capability is dangerous. If defenders can use AI to find vulnerabilities fast, so can attackers. So they're rolling this out carefully. It's a limited research preview for enterprise and team customers only. They're also giving free access to open source maintainers, the often under-resourced developers keeping critical public software running. And they're deploying new safeguards, real-time detection to identify malicious use, the ability to block traffic they think is from attackers. But here's the uncomfortable truth Anthropic acknowledged in their announcement. I quote, "This will create friction for legitimate research and some defensive work. They know they can't perfectly separate the good guys from the bad guys." For finance professionals watching this, here's what I want you to take away. We're watching AI systematically move through industries in real time: legal services, enterprise software, and now cybersecurity. Each week, another sector gets repriced. The pattern is AI capability improves, gets productized, threatens existing business models, and stocks sell off. If you're in finance, ask yourself, what part of your workflow look like the things AI is already disrupting? Data-rich tasks with repetitive patterns. That's exactly what Deutsche Bank's AI identified as most vulnerable this week, and we'll get to that report later on in the show. The Claude Code Security launch isn't just a product announcement. It's another signal that AI capabilities are compounding faster than most people expected. Speaking of things happening faster than expected, Anthropic just released their second major model in less than 2 weeks. Claude Sonnet 4.6 dropped on Tuesday. And let's talk about what that means for the pace of AI development. So Claude Code Security wasn't the only thing that was released. Opus 4.6 came out February 5th, Sonnet 4.6 on February 17th, 12 days apart. Sonnet 4.6 is now the default model for free users and pro users, and it's legitimately good. The headline features 1 million token context window. That's in beta, but it means you can feed Claude an entire code base, an entire set of financial statements, an entire due diligence room in a single pass. An adaptive thinking engine. This is interesting. Instead of the old binary thinking mode on or off, the model now dynamically decides how much reasoning a task needs. Simple question, quick answer. Complex analysis, it pauses and works through it step by step. Quick note, OpenAI's ChatGPT also has this feature. 79.6 on software engineering bench is verified for coding. 72.5 on OS World for computer use. That's navigating spreadsheets, browsers, basically files with near human accuracy. But here's what matters for finance professionals. Anthropic said, and I'm quoting their blog post, performance that would have previously required reaching for an Opus class model is now available in Sonnet 4.6. Translation, the mid-tier model now does what the premium model used to do at the mid-tier price. If you're paying for AI tools, that's good news. If you're competing against AI tools, that's the deflationary pressure everyone is worried about. The pace here is worth noting. 2 major model releases in 12 days. Anthropic isn't slowing down, they're accelerating. And they're not alone. Let's talk about what happened in China this week. So while Anthropic was shipping Sonnet 4.6, Chinese AI labs dropped a wave of new models for Lunar New Year. It's like they coordinated to make the biggest splash possible. First, Alibaba released Qwen 3.5 on February 16th, the eve of Lunar New Year. The specs are impressive. 397 billion parameters, but only 17 billion active at a time. That's the efficiency play. Massive capability at a fraction of the compute cost. They're 60% cheaper to operate than the previous version. They're 8 times more capable at processing large workloads. And they're natively multimodal, so it understands text, images, and video simultaneously. It supports 201 languages, up from 82. And it's got a 1 million token context window on the hosted version. And Alibaba is making a bold claim. They're saying Qwen 3.5 outperforms GPT 5.2, Claude Opus 4.5, and Gemini 3 on benchmarks. Self-reported, so take that with a grain of salt. But the benchmarks look competitive. The feature that caught my attention, visual agentic capabilities. This means the AI can operate independently across mobile and desktop applications without user intervention. You tell it what you want done, it figures out how to click through those apps and complete the task. Alibaba is explicitly positioning this as built for the agentic AI era. Same language everyone's using. Meanwhile, ByteDance launched Seedance 2.0, their AI video generation model. This one went viral. People are generating cinematic videos of celebrities in absurd situations. Tom Cruise fighting Brad Pitt on a rooftop, Donald Trump doing kung fu. Elon Musk's reaction when he saw the demos, quote, "This is happening too fast." Okay, so we've talked about models getting better and cheaper, but there's a physical constraint catching up to all of this AI growth. Bloomberg dropped a report this week with a headline that should concern everyone. Rampant AI demand for memory is fueling a growing chip crisis. They're calling it RAMmageddon. So here's what's happening. DRAM prices, that's the memory in basically every electronic device, jumped 75% between December and January. One type of memory chip, 75% in 1 month. Micron called the bottleneck unprecedented. Apple's Tim Cook said it will compress iPhone margins, and Elon Musk said Tesla faces 2 choices: hit the chip wall or make a fab. He's talking about building their own semiconductor factory. The root cause is AI data centers. Every Nvidia GPU needs massive amounts of memory. Nvidia's latest AI server needs enough memory that is comparable to like 1,000 high-end smartphones in just one rack. AI data centers are now consuming 70% of memory chip production in 2026. Here's where it gets real. Nvidia halted new gaming GPU development for the first time in 30 years. Chinese smartphone makers like Oppo are cutting 2026 shipment forecasts by up to 20%. Memory now accounts for up to 30% of low-end smartphone costs. It was 10% in early 2025. IDC is projecting only 16% supply growth for DRAM this year. Demand is growing much faster than that. For finance tracking AI investments, this is the constraint to watch. We talk a lot about model capabilities, software stocks, AI application, but the physical infrastructure has limits. Memory chips, power, data center capacity, all those things are important. The companies making money right now aren't the software companies, it's the picks and shovels. Memory stocks like Micron, Western Digital, Seagate are up triple digits since August. Nvidia is basically flat over the same period. The money is flowing to infrastructure now. Speaking of infrastructure spending, Meta just signed what might be the biggest AI chip deal ever. Meta committed to buying millions of Nvidia chips over the next several years. The deal is worth tens of billions of dollars, according to analysts at Creative Strategies. This isn't just GPUs. Meta is buying Blackwell GPUs, the current generation, Vera Rubin systems, next generation, shipping later this year, Grace CPUs, and this is the big one, Spectrum X networking equipment. Meta is becoming the first company to deploy NVIDIA's Grace CPUs as standalone chips at scale. Usually CPUs and GPUs work together in a server. Meta is going to run Grace CPUs on their own for inference workloads, actually running AI models, not training them. This signals a shift. Training AI models is expensive and GPU intensive, but running them, inference, that's where the actual business value gets created, and it might not need the same hardware. Here's the same pattern we keep seeing. Meta plans to spend $135 billion on AI infrastructure in 2026. A big chunk of that goes to Nvidia. Nvidia uses that revenue to develop better chips. Meta uses those chips to build AI that threatens software companies. Software companies lose market cap. The money flows upward to infrastructure. It's circular and it's accelerating. Mark Zuckerberg's quote from the announcement: "We're excited to expand our partnership with Nvidia to build leading-edge clusters using the Vera Rubin platform to deliver personal superintelligence to everyone in the world." Personal superintelligence. That's the stated goal now. All right, quick one. The moment that broke the internet this week. India AI Summit in New Delhi. Modi brings together all the AI CEOs. Altman, Amodei, Pichai. End of the keynotes. Modi orchestrates a photo op. Everyone holding hands, raising them in unity, except Altman and Amodei refused to hold hands. They raised their fists instead, side by side, definitely not touching. Altman later said, "I was sort of confused and didn't know what I was supposed to do." Sure, Sam. These two have history. Amodei left OpenAI to start Anthropic. Last month, Anthropic ran Super Bowl ads mocking OpenAI. Altman called them dishonest. That fist bump, the AI Cold War in a single image. Quick hit. Deutsche Bank ran an interesting experiment. They asked their AI tool, DB Lumina, a simple question: which industries do you plan to disrupt? The AI answered honestly: financial services. Robo-advisors will be the primary source for 80% of retail investors by 2027. Customer service. AI handles 75% of interactions by end of 2026. Media. AI competing directly with human creatives. The pattern? Data-rich tasks with repetitive patterns. Same thing getting repriced all month. Legal, software, and now cybersecurity. Quick SaaSpocalypse check-in. $2 trillion has been wiped from software since January 30th. IGV is down 23% year to date. That's bear market territory. But this week, JP Morgan and Goldman Sachs started saying it went too far. Software valuations are mid-2010 levels. My take? The market's trying to price something it's never seen before. You get panic selling, contrarian buying, then more selling when the next AI product drops. We literally saw it today. Claude Code Security launches, CrowdStrike loses 8% in hours. Is this the bottom? Nobody knows, but the pattern isn't changing. Last thing, next Wednesday, Nvidia reports. This is the biggest market event of 2026 so far. The expectations, again, are 65.5 billion in revenue, up 67%. They've got 500 billion in visibility from Blackwell and Rubin orders. Watch for a demand trajectory, China sales after H200 access was reopened, and whether they beat their earnings again. If they crush it, AI trade rallies. If they miss, buckle up. Full breakdown will be here next week. That's Weekly Watermelon Soup. We covered Claude Code Security, tanking cybersecurity stocks, RAMmageddon, China's AI blitz, and the Altman Amodei fist bump, as well as Nvidia's earnings coming up. Finance professionals still figuring out AI? Well, book a call. There's a link below. Subscribe, and I'll see you next week.